What are some of the highlights you're expecting out of the third quarter in terms of growth?
Well, despite all the noise and talk, which is really important about trade in China, the U.S. middle market economy, which generates more than half the new jobs in the United States, is driven by personal income and consumer spending. With unemployment at 3.5%, with real wage growth at about 3%, U.S. middle market companies are doing just great. They don't have the drag from world commodity price driven factors. They don't have a drag from weaker international demand. And it's important that we just see this continuing strength in the core of our domestic economy.
There's a big caveat, though, to what you're seeing, and that is that this data was collected and surveyed in the months of July and August. In the month of September, clearly, we had that weaker than expected services number, which really ignited concern about weak manufacturing spilling over. And I'm wondering if you're getting any signs from just talking to your client base as to whether or not this could be a factor in the future, or ultimately be a factor for the quarter.
We're not seeing it so far. You're absolutely right, though. For example, if you look at the NFIB data, it's still positive, but it's less positive in September than it was before. Producer price index was flat. Consumer price index was flat. We still are hearing from our portfolio companies a lot of trouble finding skilled workers. It's the number one concern, not trade. It's hiring workers to fill open positions. So I think the theme of moderate growth has continued even through September.
You know, Mr. Golub, the index, you say, tracks relatively closely or is a good predictor or correlate to both the S&P 500, the S&P 600 small cap index, and GDP.
Earnings, not price.
Not price, earnings. But could this be the time when there is divergence because these more middle market companies are less exposed to the trade tumult?
Well, for sure, just look at the U.S. dollar. And U.S. dollars appreciated almost 3% during this period. So S&P 500 companies that have a lot of their operations outside the United States, the math just requires that those foreign earnings, even if they were at the same level in local currency, are going to be lower in U.S. dollars. So you're 100% right. There are some factors here that cause divergence during this period. It's also possible that some of the estimates are just too conservative.
Does it make sense in the environment you're describing, where we are plagued by labor shortages and with the earnings that you mentioned, do Fed rate cuts make sense in this environment to you?
No, they don't. They haven't made sense to me for a long time. I think U.S. companies are having trouble meeting demand. They're having trouble filling spots. Increasing demand isn't capable of doing much good except run the risk of creating bottlenecks and accelerating the end of growth as opposed to helping the growth here.
CapEx is only expected to be up 3%, Lawrence, for the third quarter. And I'm wondering if you're also seeing that amongst the businesses you serve, that there is an uncertainty surrounding capital outlays.
Not really. Capital spending in our businesses are doing better than those statistics show. I think nationally, declines in CapEx are heavily influenced by drilling rig counts, energy, Boeing. Those factors have not had much impact on the middle market. In fact, the labor difficulties, the labor shortages are pushing more investment for automation and for productivity improvements. I think there is a certain political cloud that doesn't help, and there's uncertainty about planning, but we haven't seen that turn into any decline in capital investments yet.